Kaspar, there is a big problem in the United States in the banking sector.
Yes.
Again, it's been 15 years ago, and you're going to highlight a little bit of those problems. What is different? What is the same? And is there a solution, or what is actually going on?
Yes. And
we're quite serious because it is serious.
It is serious, unfortunately. It's not all negative, by the way, and I think we are going in depth a little bit more than what we see in the press, on the television, and in most newspapers.
Yes. Because the news is pretty much, the headlines are all the same.
Yeah, and I think people should know. If you are an investor, you should know this because it affects. And we are not only going to talk about the US banking sector, but also about the European, and not the EU, but mainly you're
Swiss.
going to talk about...
Yeah, it's a little bit of a repetition. I think we spoke about it last year in October already.
Yeah.
About Credit Suisse, of course. They were in the news today. Well, they were in the news the whole week. And the stock was going down tremendously. The biggest loss since the bank existed, and the bank exists since 1856, so that's quite a long time. This morning, however, so we're taping this on Thursday. Really good news for them, or at least it gave some calmness in the market.
Yes.
They received a loan from the Swiss National Bank, which calmed down everybody a little bit. So the stock went up 25%, of course, but it's nothing, because if you look at it, it was at 12 Swiss francs about a year ago, and it's trading at the moment at 180 or something.
But it's also where we spoke about with somebody from the sector, what you see with stock when it drops so much, then other investors come in, and the more...
it becomes a speculation stock, and you will definitely see that.
You see the volumes you see increasing a lot.
Tremendously, and normally people don't buy it, and now they think, okay, if it goes down 20%, it might pick up 20%. So you see really the gamblers getting into I dare to say that because it's the truth.
Yeah.
So why is the stock in such trouble? I'll just repeat it slightly. Of course, it had a massive outflow, 2 years of massive losses. 2021 they lost 2.something billion. Last year 7.9 billion. So that's 10 billion of losses. Then of course, because of the lack of confidence, they saw an outflow of 123 billion of client assets. They're trying to Swift, they're firing people, but each time they again run into the same situation where they just, I'm going to use the phrase here, they screw up. They have been in so much scandals, and that just keeps chasing them. And then I had to laugh a little bit because, I mean, 15 years ago, 2008, now we see all the big ministers of finance of the European countries. Now, for instance, the Spanish Minister of Finance just came out with a statement. She said, we have nothing to worry about. The Spanish system is as strong as it's ever been, and the Spanish banks are in a better position. But on the other hand, they also saw on the website of the Bank of Spain that they are requiring extra measurements, and they're requiring all information about solvency and everything of those Spanish banks, which is not directly in the main newspaper. So there is something going on again. So it's smoldering, I think, as they say in English. There is something cooking here, and you're gonna scare us all now, or
no.
Because I don't know your story. You were really quiet today and really busy. It was steam coming out of your ears with all the information you were gathering. So I'm really curious.
Okay. Now, I think this is what I have the figures for the US banking sector.
Which is an important sector.
Yes. And in general, you can say most of the figures are a little bit more accessible than European figures. So it won't say that this is also the case for the European market. It will be the case, but I don't know in what extent. So I'm going to talk a little bit fast. I'm going to show a lot of figures, and I think then if you know the figures, then you can talk about it.
Of course.
Because it's all about figures. If you look at the banking system in the US now at this moment has 22.9 trillion in assets, and then it increased a lot over the last years. And they have liabilities of 20.7. So 22.9 trillion in assets, 20.7 trillion in liabilities. So that's close to each other. So you can see if something happens with your assets, if it drops 10%, then you have a problem.
Yes.
In a nice way. So that's the first, I think, the assumption that people should understand.
And actually, may I ask? I'm going to ask you. I'm going to interrupt you, not because I want to, but those assets are the bank's assets or are those the assets of the clients?
Yeah. And from those 20.7, 17.6 trillion that are deposited from individuals and businesses.
Okay.
And to give a little bit more insight, of that amount, 3 trillion, is holding cash. But a big part of that cash is stored by the Fed. Only 0.1 trillion is held with banks in physical banknotes and cash in ATMs.
Yeah, that's nothing.
So 20.7 total, 17.6 trillion is the deposit of individuals and businesses. 3 trillion out of that that is somewhere, but most of it is with the central bank. So only 0.1 trillion is
really physically going around. Yeah.
I think that's already says something. And I'm going to screen So they always say, if a bank goes into bankruptcy, there is a pot of money, and from that amount of money we can pay off.
System,
And in Europe it's 100,000 per account holder. In the US it's 250,000
per account
holder. And if you look at that pot of money, how much is there in, and how many is there on the account? It's only 1%. Just to give a little bit of insight.
So if of the, can you relate it then to the 20.7 trillion?
Yeah, that's only 1%. but of course, that problem occurs when all banks go bankruptcy. But if you compare that,
but it's 99% is not there.
Yeah, exactly. And then a little bit background for what is the problem, because if you look at how the balances are of the banks compared to 2008, it's completely different. So what is the problem? The problem is that the interest rates that were raised in 2022, that was the fastest increasement in the last, I had data until 50 something, that was the in absolute sin, that was really high, but relatively, what's the highest ever? The
speed in which the interest rates went from 0 to 5, where we are now.
Because it went from 0.08 to 4.6, something like that. So this is a 75 times increase. And there's the problem. It won't be. It is
also because the inflation, of course, required. That. The inflation also went from nearly nothing. We will put it up.
Yeah.
So they had to follow that.
Yeah, or they had to act earlier or in a different way.
Yeah, but that's what I think you also mentioned once before. There's no other. They can't do anything else than what they're doing now. That's the only mechanism that they have.
Yeah, okay, but they also could, I think, act more on the energy prices.
Oh yes,
especially in Europe.
Yeah. Okay, but that's of course not what the Fed can do, no.
No, but because of the stimulus,
it's a of course.
Yeah, and the stimulus in 2020, 2021, a lot of people placed deposit with banks. You see, in that period, a lot of money is placed with the banks.
Yeah, we showed the chart once before, the amount of cash, but it's completely disappeared again. Eh?
Yeah, but so it was placed with banks. The banks received a lot of money. They had to buy something into the market, and they bought really, and there's the problem, they bought fixed income securities for really low yields.
Yeah, because there was nothing else.
There was nothing else. And of course, banks need to buy a certain percentage of their holding in really risk-averse instruments. And because of the increasement of the interest rates, the value of those instruments, bonds for example, they dropped a lot.
Yeah, because the interest rate went up because of those
I have an example. I have 3 examples, but I want to highlight the second one. That is the US. That was a bond that was issued in 2020 for 100%, and that had a coupon of 1.25%. So you had you received until the duration 1.25% of interest,
which at that time was nice.
But it was okay. It was the market, 2020, but it has duration until 2050. So it had duration of 30 years until 2050. So what's happening? You get 1.25%, interest rates go up, the value of that bond goes down, and but people should realize that's the most, we as a market say, this is the most risk-averse investment you can have. AAA investments.
Yeah, and it goes down 30%.
And it's trading now at not even 60%.
Yeah,
So it goes 40% down. So you have shares, you have CFDs, risk products, and you have bonds. And within bonds, you have the most safe bonds, the AAA bonds. And you have now bonds.
But it's basically going back to the principles, no? If interest rates go up, bond prices drop.
Yeah. And especially,
you can see it clearly here.
Especially bonds with a long duration, and then you have increasement jumps that you never saw before. That's what's happening.
Yeah.
So there are a lot of banks have in their asset class the most risk averse investment. They have bonds where they are losing 40% on.
And you might have asked a question.
Please, Martin.
But you don't think, because we have also clients and we deal with retail clients that they have futures or options on that. Do you think that those banks have
cover it,
that they hedge that risk?
Yeah, some of them they hedge.
I think because then of course then okay, you lose there but you win there.
Yeah,
So it's
but mainly they hedge the interest the interest risk, that they hedge a lot. And the loss the loss in the value that they hedge less. And if you see here, I will say it here, you can see in this chart, we put it in the screen, it says unrealized gains, losses, losses on investment securities, on fixed income.
And there you have the answer.
Yeah.
Yeah, I'm sorry, I'm so excited, but that's basically what I just asked you. You confirm here that they haven't really hedged that.
Yeah, and so held to maturity securities, that are the bonds that they agreed on to hold until the end of the duration. And you see how big this is. And the available for sale securities that you can make cash and you can sell. So normally as a company, if you make a loss on your investment, on your balance, you have to say, okay, we report a loss. It's now if you have a company, you buy a house for $1 million and it drops in value 500,000, you have to say at the end of the year to do the accountant it's 500,000.
Yes.
But there are agreements within banks that they don't have to report their losses because they say they have an agreement. We agree that we keep it until the maturity date.
Yeah, but
so
in this case.
Yeah, so okay, it's also fine. But then, and that's what happened in America, but then people come and say, I want my money back. And then they have to sell.
By all means, they need to avoid a bank run.
Yeah.
Because they have, I'm using the phrase again, they're screwed then.
Yeah.
Really badly.
So when nobody takes the money out, not a problem. But if a lot of people, or 10% will take the money out, then they have to sell those bonds, and they have to take the loss, they have to report the loss, and then they are insolvent. That's what mainly is happening.
So you should really.
It's not really positive, but okay. So it's a different story than in 2008, because then there were a lot of
it's completely different, but sort of like the same.
Yeah, but then it was more on the asset side. Yeah, it has similarity in it. So that's what happened with the SVB bank, and I want to say something about the banking sector. If you look in nowadays, there are 13,612 different banks in the US, and they have 23,000 branches, but 13,612 banks. 10 of them, the 10 largest banks, they hold 50% of all those assets.
So that's not where the risk is.
No, and they are much.
the other 50%.
Yeah, and if you see in this chart, I don't know if you're going to show this again. Then you see the large bank versus the small banks and how they are, how much cash they have in relation to the total deposit. Then you see these are the large bank. This is 13% versus 7.5% for the small bank.
Yeah.
So the conclusion is the large banks don't have a problem so much. The small banks, they can have a problem. Depend per bank how they have their balance.
Yeah.
And the market knows. So the market knew, oh, the SVB bank, they have a problem. We take the money out, and then you create a bigger problem.
Yeah, the market is much further ahead in this case. Yeah.
So, and this is the case.
But there was another bank also, like they didn't.
There were two other ones.
Yeah,
Yeah.
the New Yorker bank or something like that.
Yeah. So this is the case for all smaller banks worldwide that have relatively a lot of assets. When they had a lot of new money coming in 2020, 2021, they have relatively more invested in those bonds mainly, and those dropped in. So I think that. So what can you do for you as a private investor? Look for yourself. How is my bank where I am banking?
Yeah.
Of course, the first thing, and then if you have cash money, then you can also put it in bonds. You can buy your own bonds.
Yeah, we can show examples.
We do it all the time.
Yeah, it's really simple. If you have dollars.
Short duration, eh? 2 years, 3 years.
Yeah.
What are you going to make then on that? Triple A bonds?
In the US, it's 5 something, and in Europe, between 2.7, 3%.
Yeah.
And now with the interest rate hike, it might be slightly more.
Yeah.
So make it like Europe 3%.
You can sell them. You can sell them
any moment.
Any moment.
Yeah, but what the nice thing is, you make a ladder. So you buy one that terminates in 6 months. Then you buy another one which terminates in 8 months. Another one that terminates in 10 months. Another one that terminates in 12 months. So you've got a bump. Each 2 months, you have money coming out of the bond portfolio again, and you can either decide what is the interest at the moment. You reinvest it again. One further ahead, and there's so many possibilities.
So you use exactly the same product, the same where the problem is, but the problem is they have a long duration. You take a short duration.
Yeah.
And the biggest interest hike is already happened last year.
Let's hope so. Yes.
Yeah. But if not, if you buy it at 100, in 6 months on a year, you get your 100 back.
Yes.
Maybe we have courses about it also.
Yeah.
The last thing, and that I found also remarkable. It's in the same line, and that's the Fed negative capital.
Yeah, that's another story. Yes.
Normally, in normal days, normal years, the Fed generates money, income, because they lend money out, interest rate, and they have products, and they have interest coming on there, and vice versa. And normally they make $100 billion a year. $100 billion. That's what they make, the Fed, and that goes to the government.
Exactly.
And it's quite some money. They can do something.
It's
with
income.
It. Yeah. Now, because the strange market, it's reversed. The Fed is losing $2 billion a week. So it's almost $100 billion a year. So for the income for the United States, they're missing 100. Now they're even losing. And the negative capital of the Fed is minus $1 trillion. That's already the case. But of course, they can't go bankrupt, and they
That's their advantage.
They can't be a bank run, so they can hold the securities. So they have also the securities that are underwater. So it will work out. But the conclusion that you can draw there is that the Fed is not that much in control about themselves, but the U.S. government is. They are much closer, those institutes in the US together, than in Europe. So probably the government will take more control over the Fed.
Yeah.
And you know what governments do? They have their own plans.
Exactly.
So
to summarize,
I think
what can you do with this as an investor?
I think
you give a clear point, right?
I think the problem is there. How big the problem is, that depends how the market responds. If the market thinks, hey, there's a problem with that bank, they will take the money out, because that's what market do. And then the problem will be a problem for sure.
Yeah.
So look for yourself, where do I have my money? Look at the bank, because you have also smaller banks that are really well good financial positions. And the second thing you can do is to, if you are worried, place your cash money invest in
don't leave it cash.
Bonds.
Just don't leave it cash.
No, in bonds with AAA, AA status with a short duration.
See you next week.
I hope we don't scare you too much. There's always a solution. See you next week.